Joining us right now with more on today's market moves, Jim Paulsen, who helps oversee $375 billion as chief investment strategist at Wells Capital Management. He comes to us from Minneapolis. Jim, great to have you back here on Bloomberg News. Adam, just talking about Dow Theory. You know, we've seen some movement in those transports, but they're still the laggards when you take a look at the trade this year. How closely do you watch that Dow Theory, and how significant do you think it is?
I don't watch the Dow Theory that closely, but I do take his point. And I would include not only the transports lagging, but so far this year commodity prices have been lagging, which is sort of the same story, the raw materials. But today, both are having a big move. And the commodities as well as transports, both are kind of catching up to that. You know, Carol, what I take away here is we're having a good old-fashioned earnings-driven bull market right now. I know I'm not saying it's going to last forever, but the concern about sales to me is somewhat interesting in that I don't see why anyone would expect there to be much of a sales story at the bottom of a recession, which is where we're at. What we do have is a tremendous margin story going on, or a lean and mean story, where corporations cut down and purged payrolls, inventories, cap spending over the last year, preparing for the second coming of the Great Depression. And now what we're finding out is if it's any better than what people feared, we got tremendous profits leverage to the bottom line. In a few quarters, on top of this great profit leverage will come the sales, and then this earnings story could really become something.
Jim, I get it, but it still sounds like there's a lot of ifs out there. You know, we heard from Ben Bernanke this week, and he too was kind of, I felt like, tempering enthusiasm when it comes to the economy. You know, maybe lean and mean for the companies, but it's still going to take a while for the economy to turn around here.
I think we're growing in this quarter, Carol. I think second quarter that'll come out here soon next week. GDP will probably be close to flat, maybe down a little, but I think we're going to have growth in real GDP in this quarter and beyond. And we've now got the stimulus, all this fiscal and monetary stimulus with about a year's lag coming in September. On top of people just calming down and returning to normal spending patterns, I think we're going to be surprised by how fast growth returns here in the second half.
You said normal spending patterns. You know what everybody says about the consumer. They're not spending. They're socking their money away, and that's going to be a lasting trend. So if you don't get those normal spending patterns, then what?
Well, I tell you what, we probably won't return right to normal spending patterns, but if we get some spending patterns again, which is what we're getting from the consumer, on top of getting 1 to 1.5% through the trade window instead of losing that, instead of getting burned out by a loss of 1.5% through construction spending, let's say we lose none or gain a little bit, on top of some inventory build rather than inventory liquidation. I'm saying there's a lot of other pieces here that could come together with mild consumer spending to still produce a pretty darn good GDP number.
You know what I'm wondering, Jim, and I'm taking a look at the Dow. If you look at it back over 10 years or so, you can see that we had this kind of drop, maybe not as significant, back from 2002 and then recovered from it, obviously. But that recovery back up from 9,000, 10,000 up to 14,000 was mainly fueled by the housing bubble, right? So if we want to take a run like that again in such a short period of time, 5 years or even 10 years, do we need some other sort of asset bubble to help us do it?
Well, I think so, but I think we've got it. And I would argue that what we've been doing for the last decade, the United States has been spending in excess of their incomes, Matt, because they've been building out this new world called the emerging world consumer. And they're up and running now, and they're sort of self-sufficient capitalist contributors. And we're starting to see evidence of that with our trade deficit in this country. It was burning 1% off our GDP numbers. It's now adding 1%. I think that's going to be a contributing force. We didn't get much business spending in the last cycle because of the dot-com meltdown. I think we're going to get more business spending again in the next recovery. So I think there are some pieces that might pick up the slack, even if the consumer stays a little more subdued here in the next several years.
You know, that makes sense, and it's helpful, obviously, to the big multinational companies that sell things over there, that work over there, but it's not really helpful to the U.S. worker, is it?
I don't know. I disagree with that a little bit, Matt, in that I think the biggest loser of a decade and a half of trade deficits was the blue-collar manufacturing worker in this country as we lost competitiveness overseas. If now our trade deficit's going from negative to less negative and ultimately to positive, then some of the beneficiaries of that is going to be blue-collar labor force here in the United States again.
What can we make to export over there? I mean, we're not going to make cars to sell over there because they do a pretty good job themselves. And software, you just don't really need that many people, right?
Well, I think you'll be surprised if we start changing the exchange rates, which is what we've done, which has already turned trade against the developed world. If we now start changing the exchange rates against places like China and India and Mexico, that could do a lot of damage. It's also not so much about exporting more necessarily as it is about repatriating a bigger part of yours and my spending dollar. If we quit importing as much and some more of our own spending stays home, then that can create a lot of jobs here domestically.
All right. So, Jim, you do sound rather upbeat here. Let's talk a little about strategy. I mean, you like some of the consumer discretionary names. So, again, you're banking on the consumer kind of coming back here.
Well, it's a combination, I think, Carol, of not only the consumer coming back, which I think they will. I mean, it's not hard to argue that when it's basically flat, maybe coming back again, but also that people have such a pessimistic attitude about the consumer. Even if they don't come all the way back, but they just come back a little more than people expect, that means these stocks are probably undervalued. We're pricing these stocks for a consumer depression almost, and if it comes out a little better than that, then the values are probably understated. That's not my favorite sector necessarily. I think the industrials and the materials probably got more promise from here, but I'm okay with some of the consumer discretionary as well.
But you have backed off technology. How come? I know it's kind of had a great run, definitely outperformed the broader market here.
That's about the only reason, Carol. I think I love the fundamentals around technology. I think business spending is going to be a leader in this coming cycle. Again, I think that we had a decade where no one bought on new era tech. The emerging world needs a lot of that. It's just that these stocks have done so well off the November bottoms that I'm seeing if I can get a little bit of a pullback in their relative price performance and then maybe go back at them again.
All right, so look for some new entry points at that point. Jim, hey, thanks so much. Take care now. Jim Paulsen from Wells Capital Management.